everyone. This is Abhijit Chatterjee and Rohan Singh recording our Charts Are Fun weekly session. This is for the week of June 24th. Today is the June 28th, the last day of the quarter. A lot happened in this market this week. As usual, I'm going to talk about the markets, talk about what happened in the overall markets, then the sector ETFs. And then from there, we'll talk about we seeing an underlying rotation going on in terms of money moving out of semiconductors into software. So we'll talk about where we see SMH, money rotate out of SMH, which is the Semiconductor ETF, into IGV, which is the Software ETF. And we can see one of the key drivers of that is Microsoft, which actually has quite a bit more upside. So right now is still the largest market cap, and we'll show where we think Microsoft is headed. Also talk about Bitcoin, because we feel that Bitcoin had a big movement this week, and we'll touch on the causes of that and see where it could be headed. So with that, let's just share my slides and go directly into the charts. Let's go full screen. So this is our website, our Charts Are Fun YouTube channel. We request you to subscribe to it. If you like the videos, do hit the like button. We publish weekly videos and also shorts wherever possible, which are within a minute, talking about particular stocks and patterns that we see in stocks. So appreciate that. And then we also have our blog site, Charts Are Fun. In particular, we try to publish daily blogs, and this last one that we published this morning is about Nike. Nike's earnings was quite a downer, in particular their future earnings. There is expected, shortfall in earnings. They are talking about, mid-single digits kind of revenue deceleration, and that's not what the market was expecting. And initially, they had talked about growth in revenue. So there is a new line of, sports shoes that they are going to be launching, and with the Summer Olympics, perhaps there is hope. But actually, the stock said something else. So we're going to talk about that and look at the chart. So let's go straight into Nike's chart today. And this is the block that I had shared. What we see here is a classic descending triangle. Why? Because if you look at the base here around 88, it broke down from the base. The tops are declining from 120 to 106.95. And if you measured that, you subtract 120.88 from 122, that's roughly, we're talking about 34 points. Subtract 34 from 88, it's about 54. So 54, about there is where we think the descending triangle pattern is. 80 was the low of 2022 October, and today it broke below that. You can see a very bearish kind of engulfing candle starting off at the highs of the, this is a weekly chart, so highs of the week closer towards the 98, 99, breaking all the way down and closing near 75. Very heavy volume today. We can see that it traded 176 million of volume, the highest we've seen in the entire 3.5-year period. So not looking good. Nike looks very bearish, and in particular, their fundamentals weakening is what. And this, by the way, is the descending with the bearish flag, and every sign in here are not looking good. And one may want to play a kind of a reversal bounce towards the $80, but I think you're better off watching this, see where it finds a bottom. It's terrible to be able to go to catch a falling knife. So I would recommend that just watch and see where Nike forms a bottom, then tries to base around. And from there, once it forms a base, then it's worth considering. Right now, if you really had to look at footwear, you should look at ON, and that's kind of doing very well. Or Deckers is also doing extremely well. So those are the two that I would recommend looking at. If you're Deckers, though in some ways has already shot up a lot, the upside is not as much as in ON. So that's what we talked about in our blog, to consider investing in that. So this week in particular, there were two key YouTube videos that came to our attention. One is classic Mike Wilson, as we know, has always been bearish about the market. He's been for the longest time calling for a recession, and he's done that over the last couple of years. Has been proven wrong. So then he raised his forecast on S&P. Initially was, in the 3,200 camp. roasted up all the way up to 5,400. He was in risk reversal. This is a talk show that on a daily podcast that Guy Adami and Dan Nathan from the Fast Money show run. This is their own channel called Risk Reversal. And they bring in Mike Wilson every end of the quarter. So today being the end of the second quarter, they brought Mike over. And as you can see, what Mike shared here is a classic chart of the equity risk premium. So you look at in this particular case, the S&P 500's forward. This is a forward 12-month earnings yield. So if you take the earnings divided by price and look at what is the yield of earnings to price. So it's just the reverse of P by E. You just inverse it. And basically you take that as a percent and then you subtract that from the 10-year yield. This is the nominal 10-year yield. And turns out when we have shocks in the market, the risk premium shoots up. So we have, and the y-axis is in basis points. So 800 is 8%. So 800 basis points was as high as where the risk premium went back in the 2008 financial collapse. And towards the 2011, this was during the Euro kind of crisis in Europe. It had also shot up at around that time. However, since then, it has been steadily declining. In the COVID collapse 2020, also it had shot up towards the 7 basis points. And we can see that now it's headed in a very steady downward trend. So Mike's raising a caution that as the risk premium is at all-time low, earnings risk is at 20-year highs. And the earnings risks are we know that the interest rates have been high for a long time. And there is potentially that impact of that to slowing down the economy, slowing down earnings down the line. There has been, of course, euphoria with AI. There's been tremendous amount of productivity gains, efficiency gains from that. And that's what people are very bullish about. But there is definitely an impact to these, high interest rates that could come and hit the economy. And that does change the picture on the earnings risk of equities. And hence his concern is that perhaps this could spike back higher, and that would mean the growth stocks would get hit and the market would pull back. That's his caution. So that's what he shared it from an economic warning, and he predicts some form of an economic event that could trigger it. He doesn't know when it could happen. He's even said within the next couple of weeks, could happen another year later, but he sees something like that potentially in the horizon. And he does not weigh out the recession risk altogether. He still sees, if not towards 50%, somewhere elevated around, this is not definitely not in the low part of the risk. He does see reasonable risk for recession coming in the economy. Now, the part that is to be watched at, and that's what the bulls will point you to, is the mid-90s when tech stocks grew. That equity risk premium, by the way, went to the negative zone. And Mike Wilson didn't rule that out. He said, well, that's the other possibility if he's wrong and it turns out that we do not get any of the recession or any of the causes for the equity risk premium to go up. Perhaps it could go into negative territory like it happened in the late 90s. So many people compare today's market to the 1995 time horizon. And from there, how the economic technology-led economic growth happened. And that points us to a very bullish analyst out in Wall Street, Tom Lee. He was out in CNBC and he has now been boldly making, it's the first one who's made that bold claim, that in this decade, we will see a tremendous growth of tech-driven stocks, productivity, talking about, he used the whole idea of demographics. What he's saying is this is the third time US is going to see it. They saw it in the roaring 20s, 1920s, of course. Then they saw it in the 1950 to the 60 period after the World War II. And then he's expecting that this decade, for the next 6 to 7 years, we're going to see absolutely strong upward climb. And he's projecting an S&P 500 target triple from where we are right now, from 5,500 towards the 15,000. So that's a very bold claim. He's claiming that the Gen Z and the millennials will start being the 30 to 40 age group. They will be spending into housing. They'll be spending into their, economic growth. And that's going to be one of the factors driving the S&P 500. And then he's also talking about there's a global shortage of employment, global shortage of skills. And that is going to be met this time with technology powered through AI and through technology powered enhancements. And he believes that that will help drive towards companies growing and the earnings from them projecting. And in particular, US, he claims, is going to be the biggest beneficiary of this because that's the technology capital of the world. No other country comes close to the technology excellence, the technology innovation that the US produces. So he's actually very bullish, and that's where his predictions were. So now, while all of that is set the stage, Mike Wilson on one side, bearish, continues to be bearish and cautious, I would say, and and Tom Lee being on the other extreme, extremely bullish. Let's just look at the market, what happened this week. And we have kind of sorted this out by the rate of change. This is the 5-day rate of change. So for the week, small caps were the best performing ETF. These are all ETFs for the core indices. IWM is the Russell 2000 ETF. And I'm going to talk shortly more at where we think the IWM could be headed. But this is a classic, potentially cup and handle forming. So right around the 211, pulled back to 190, went back to the 209 level. Kind of a little too deep for a handle. Handle is usually a little shallower, but it's got all the nice forms of a handle forming. And a break above that would take it to 230. So that's something we're going to watch. Today, it actually had a bullish kind of a move, breaking above the 202 towards the 204. Pulled back a little bit, but had touched 204 today with some decent volume. And we can see in the recent black upward kind of volumes, when it's moving up, we're seeing some buying interest come in. Rate of change in this case is now starts beginning to climb. So next week, next couple of weeks could be strongly bullish for small caps for us to watch. So this was the strongest ETF this week, the IWM. Then dollar was very flat. There is an upside projected on the dollar, as I've talked about. In particular, the dollar ETF is UUP. I see this headed towards 29.6. It closed at 29.13. It was kind of 0.12% for the week. Gold was also kind of flat, 0.11% for the week. This one also, potentially you could say that is kind of forming. Some people called it a double top around 225 and being bearish, but this is a bit too deep for a cup and handle, but you could call this a bullish flag. So right there is a flag pole from around the 180 level towards the 225, and that pole is now forming a handle, kind of a bullish flag, not a handle, but a bullish flag from the 225 to the 210. So this, when it breaks out, would definitely go a lot higher towards the 235, 240 levels, something for us to watch. S&P 500, as we know, has had a solid climb, steadily climbing above on its 20. These are all daily charts. So the 20-day moving average. Then it broke below towards the April when we got a very sharp pullback. And then now it has begun its climb. The 20 days now has a silver cross above the 50. Both the 20 and 50 are climbing, and it's climbing higher. The target on this near term is 5,700. And we have a feeling that that's very much in the cards over the summer, in the next month or two, that S&P could get there. There has been a very bullish forecast of Goldman Sachs calling for 6,100 now. That's the biggest bullish forecast beyond Tom Lee, of course, who's projecting 15,000 for 2030. Goldman Sachs's prediction for S&P 500 is closer to 6,100 over the next few months, around election time. Diamond, this is the Dow Jones Index ETF, that was down minus 0.25%. So both S&P and Dow Jones were kind of flat, down slightly at minus 0.05%. QQQ was also pretty flat. So initially, it kind of gave up some gains and climbed, and then today it gave up some gains again. So this is QQQ. Also has a bullish in terms of the 20 climbing with the 50 silver cross, or the 20 above the 50. The target on QQQ is 520. So while S&P is 5,700, which is about 570 in SPY, QQQ's target is 520. We closed near just below 480. There's another, you could say 40 points or so of climb in QQQ, and that's something that we'll be looking at. The emerging markets EEM was also negative, not a lot, minus 0.19%. This is potentially also a cup and handle I'm looking at. So initially, as the dollar climbs, it's not going to be very bullish for emerging, but once dollar achieves this 29.6 target and then we start getting dollar pulling back, it'll help the emerging markets break out. And I have a feeling that from 41 to 43, that's a 2-point move. At that cup and handle measures to 45. So I have a feeling that this could break out higher towards the 45 level as QQQ goes to 520 and S&P to 5,700. Silver is also kind of a, you could say that this is a flag forming with a bullish pole from 24 to 29, kind of testing the 29 to 26 in a shallow form. And then, and as you can see, volume is declining on this pullback. That breakout measures to 31, 32. So I see silver SLV with some more upside. It was down minus 1.5%. So this week, the key ones that got hit hard is silver, TLT. They got 2.3% pullback. VIX has been steadily coming down, which is a bullish sign. VIX is always contrary to the market. When VIX comes down, market goes higher. So the fact that the volatility is coming down indicates that the fear premium is coming down, indicates the market from a bullish perspective thinks that there is less fear and market will have more upside ahead. So that was down 5.676%. And the biggest hitter that took a bad hit, and which I'm going to end with, talk about Bitcoin and what caused the sell-off, but that had actually a 6.66%. Now this chart, which is the Bitcoin ETF, the biggest Bitcoin ETF, Grayscale, in many ways is printing out a, call it the double top that the bears would point at, with 65 touching twice. And then if that breaks below 50, that could easily take it down towards the 35 level, and that could be very bearish. But what could be on the bullish side is this perhaps could be a flag pole right here from 30s towards the 65, and then this could be the bullish flag happening. As long as it trades between the 50, maintains that support, and 65, that breakout would easily take it a lot higher, would take it easily towards, we're talking about almost the 80, 50 to 15 points at 15 to 65, 80. So that's where GBTC could head. And the potential correlated value of the Bitcoin BTC on that would be closer to 87, 88,000. So that's something we're going to watch, and I'm going to talk more from a look at the chart there. So looking at the sectors, we had talked about this last couple of weeks about energy, potentially XLE in particular getting a bottom closer towards the 88, 89 level, and then from rebounding. And that's exactly what we got. We had just published a blog about it. You can go check it on our blog site. And we got a nice rebound coming in here. I expect further upside on energy. That's something to look at. And that, by the way, is being dampened by the dollar upward move. And over the last 3 months, energy is pulled back from April through, through June, 3 solid months of pullback. But this summer, I expect XLE to start have an upward move. As the dollar pulls back, it will help XLE kind of get its boost. Communication services where the internet stocks are, Meta, Google, and others. Google recently, we know, broke out. It's helping the XLCs break out, move higher. You can see a beautiful cup and handle on XLCs, somewhere near 76 to 83. That's roughly 7 points. Add that to 83, that's 90. That's where it's headed. So today, it kind of pulled back a bit, has touched 87 recently, but we see this closer towards 90. So XLC remains bullish. The real estate is help directly gets beneficiary of whenever interest rates come down. We know that the 10-year yield has been declining from 4.7, had recently reached 4.2. And TLT, we know, had a negative week this week, though, which means that the 10-year yields did go up a bit this week. But in general, this, if the 10-year yield does break below 4.2, that'll actually be not just bullish for small caps, bullish for the real estate XLRE as well. And this potentially could be an ascending triangle that's forming. The ascending triangle's base is around the 39 level. The from 35, it's been climbing. That's 4 points, 39, 43. So XLRE is where I see an upside towards 43 potentially shaping up. Discretionary is something I'd like to talk because we had blogged about it. We had talked about Tesla, and it was in our last week's video as well. We talked about Tesla, Amazon, Prime for a breakout, and they both broke out this week. Discretionary is those are the two biggest components, Amazon and Tesla. And the fact that we see this kind of a beautiful cup formed from somewhere around 168 towards the say 184 level. So that breakout can actually take discretionary significantly higher. So you're talking about roughly from 168 to 184. That's 16 to 184. That's 200. So potentially there's a chance that XLY climbs as Tesla's upside projection, by the way, we talked about it in our last week's video, is much higher towards the 255, 256 level. And Amazon's is also much higher. It just broke out above the 190 level. We see that upside closer towards the 220. So there's decent upside in both of those key discretionary components. Financials have been kind of range bound between 40 and 42, got a little bit of flat move this week. So basically, the only thing that did very well this week was energy and communication services. Energy 2.38, communication services 1.16, and the real estate 0.83. Everything else was kind of flat, 0.1% discretionary, minus 0.14 for financials. Healthcare was minus 0.33. But that, in many ways, also potentially making for a breakout. Healthcare from somewhere around 138 to 147, that's about 9 points. Add to 147, that's 156. It has potentially formed the cup already from 138 to 147, pull back to a handle. I expect this to break out and move towards 156, which could effectively, get some upside on healthcare, which means the pharma stocks, biotechs will help in that climb. So there is actually technically, what I'm going to point about is there's going to be some rotation going on as the next leg of the market, as S&P climbs higher. Expect some other sectors to take the lead, not technology as such. Technology has already had an awesome move, since the October of last year's lows for the last literally 8 months. Industrials kind of is also a bullish flag. So you can see the flagpole all the way from 110 to 126. Then it's kind of range bound between 120 to 126. So this is kind of a bullish flag forming. So if that break up above 126 happens, this you could measure and easily get a target closer towards 135, 140. So that's a possibility in industrials to continue help the market climb to the 5,700 target for S&P. I see a beautiful ascending triangle forming on staples. The call it the upside horizontal is around 78. I see rising lows from 75, somewhere near 75.5 towards 76. So those lows, if you kind of join them, is ascending. And then the base on the top, the resistance level is 78. So 75 to 78 is about 3 points. Add that to 78, 81. So that's where I see staples headed, which means you could expect Coke, Pepsi, those stocks to do well. Those are, and Procter & Gamble, some of those to do well as staples breaks out higher, something to look at. Technology, we know that has already kind of met its target because XLK, as we see, it was from a 210 level to towards the 190. That is where it had formed its base and then broke out. And that's measured towards the 230, which it recently tested and met that target. So we may get a sidewise movement before it starts coming back down, is what I feel on the XLK. And it already this week had down minus 0.78%. So XLK down minus 0.78, staples down minus 0.66, industrials down minus 0.55. And the two worst for utilities and materials, basic materials, of course, is impacted by commodity prices, steel, copper, gold, silver, all of that has been declining. But potentially, if gold and silver have more upside, XLV should break above 92. So that's something we need to watch. This is also a classic flagpole with a flag forming. So break above 92 could take this easily to 96 and so on. Utilities is also a very, very parabolic, which is very rare to see in utilities, but this was AI driven back in April and May. It had a huge climb because the utility stocks started coming up and saying this insatiable demand for electricity from all the data centers. And that was very bullish on utilities. So that's got a pullback, but this is kind of a declining volume pullback. I think this is kind of a congestion, and then I expect a climb higher, break above the 72 level. So XLU potentially has some upside if it breaks 72 towards the 75 level or so. So that's kind of where we are from a sector perspective. And I'm going to talk about a core summation index market breadth. So one, for sure, market has been climbing higher highs. This in particular is the Nasdaq summation index, but we know that there is divergence here. The summation index has been setting up lower highs. So from 511 that it tested from its October moves as it went up towards late December, it has been basically from 109, it touched in March. Then we got the April pullback when it came all the way towards the minus 467. From there, we got the rebound. But while the market is moving higher, even through May into June, the summation index topped out at 54 and has been declining while the market is climbing. That's not very, very bullish sign, which means market is getting more and more weaker. Internals are getting weaker. The breadth is getting weaker. And potentially what we could expect is in this last climb after QQQ gets to 520, we could get a much sharper correction, something to be concerned about. Now, of course, we can see that the RSI on the Summation Index is deeply oversold. And today was the first day where you can see it went up plus 4.79 after steadily declining from that May 20th towards for almost more than a month and a half, literally towards the end of June. So with the Summation Index, once it starts going higher, it keeps climbing in a steady way for a few weeks at a time. So the next 2 to 3 weeks, there's a potential possibility. And typically July, in anticipation of earnings, June tends to be a bit bearish. July tends to be very bullish. If you remember last year, market kept climbing towards till late July, and then it topped out and pulled back in August. I expect something similar. Expect this July to be also very bullish, some more upside in the market. I'll show you where we think we are headed. And then from there, August onwards, through the uncertainty of elections and so on, expect to see some kind of a sharp pullback from August all the way to late September, October is when will be time to buy the market again. So where do we think the Nasdaq Summation Index correlates to the QQQ? Well, we see clear negative divergence. This is the hourly chart of QQQ. When it tested 486 last time, the RSI was much stronger. Today, it tested 487. Didn't really end at the highs of the day. It actually pulled back and closed the lows of the day. So this is kind of a bearish sign. We see very heavy volume in the last hour of trading, closed near 479, and that negative divergence means lower highs on the RSI. Same thing with PPO at lower highs. A bit of a negative divergence. However, if we get, and I'll show you where I think the small caps actually are poised to do very well. If small caps are some upside, it's unlikely that QQQ, there'll be rotation for sure. And I'll show you rotation of semis going into software, for example, rotation out of some of these technology stocks into small caps, for example. But this potentially could be a bit of a cup and handle from 486 to 473 back to 487. That's roughly, you're talking about 14 points. Add that to 487, 501. So that right there on the hourly chart is 501, but I had previously shared a longer-term weekly chart of QQQ, and that one's got a cup and handle all the way up to 520. And there's a very good chance. Momentum is strong. We have been climbing. We could get there in the next few weeks. Small cap is what I wanted to talk about. This is the hourly chart, and this is a very bullish chart, at least from a very, very near term, looking at where we are. So yes, we had gone to 207, pulled back to 198, back to 207, and then we tested that 197 level twice, right? So this is now turning out to be a very decently strong support, 197, 198. But what we see here in an hourly chart of the IWM is from 202, 197 back to 202, and then 198 and climb higher. So this potentially is an ascending triangle, and that breakout from the 197 to 202 is roughly 5 points. Add that to 202 is 207. So 207, 208 is very much in the cards next week. And look at how the small caps ended the day in the last hour of trading. Heavy volume, kind of was towards the 201 level, reversed higher, closer to the 203. That's a nice bullish buying towards the last hour of trading, which means money is rotating into small caps. I think this is potentially move towards the 207 coming early next week. So TNA is the way to play it if you want to be aggressive in small caps. TNA is 3 times the movement of IWM. So if IWM today was up 0.41%, TNA was up 1.2%. So potentially a good way to play the small cap move next week is consider buying TNA for a near-term trade to play this upside. We talked about rotation from semis to the software. So let me show you the SMA chart. This is also a very bearish looking negative divergence. We know that their bigger term picture on SMH was from 80 to 160, 80 points to 160 is 240. It already met 240, it went to 280. So it exceeded the target on this cup and handle on SMH. It has since then formed a negative divergence with RSI at a lower high, PPO at a lower high. I would expect SMH not to have as much upside as QQQ goes towards its 520 target. If anywhere I see some upside coming is actually in IGV, which is a software ETF. We see a beautiful cup and handle. The breakout has not happened. This is in anticipation, but we'll see what happens next couple of weeks. So this is right around 89, pull back to 47, back towards 89. So that's a cup. A beautiful shallow handle pullback happened to 76. The last few weeks, just like you saw that the semis kind of pull back the last couple of, these are weekly chart, by the way. So these two candles being red, kind of a long bearish tail on the SMH candle previous week, and this week kind of pulling back, maintaining its decline. The IGV has actually been climbing, showing the money moving into the software stocks, and for 4 consecutive weeks it has climbed. So June has been a very positive month for software, and we expect this momentum to continue. Now, what would be the core driver of this? The biggest software stock is Microsoft, and it's also the biggest stock in QQQ and S&P. It's the classic 3.3 trillion plus market cap. This is also a beautiful cup and handle, 342 to 210, back to 363, a shallow pullback to 307, forming the handle, distance broken out. Of course, there is a bit of a negative divergence, but that could easily be invalidated with RSI climbing higher highs as it moves. Where is the target on that Microsoft? It's towards 517. So if Microsoft has to go 517, you can easily see IGV, which is the software ETF, climb towards the 130 target. How did we get the 130? We took 47 and we took the 88 level. So that's roughly, or 88, 89 level. So that's roughly 41 points added to 89. That's 130. That's how we get to 130 on IGV from present levels near 87. So that's decent upside where IGV, I think, and we've already seen the momentum in CrowdStrike. That's also one of the core components of IGV. Yes, we had a bad pullback on Salesforce, but that since then has got a bid and has been climbing higher. We had an awesome breakout, a nice move in Adobe, which is also a core stock of IGV, the software ETF. So Microsoft, Adobe, CrowdStrike are already the strong, powerful stocks climbing higher highs every day, helping the move, but expect other software stocks to get a bid. So it would, in many ways, if you think about the AI play, you first had the hardware play, the Dells, the NVIDIAs, the SMCIs, those did very well. Now from that money rotating into the software plays, the beneficiaries of this AI, as they kind of monetize these by putting this out to customers who are consuming the AI brought into these softwares. We know that Salesforce has heavily integrated LLMs and generative AI into Einstein. We know that Microsoft, of course, with Copilot, with their investment in the OpenAI, has been heavily pushing generative AI into all their AI Azure cloud. And the other stocks are all going to be starting to use AI, especially the different aspects of generative AI. And we see that Amazon is also a beneficiary of that. Amazon is not in the software sector, it's in discretionary, but we had Amazon breakout this week. So with the Amazon, Tesla breakouts that we got, with Microsoft upward trending towards our target, closer towards the 518, expect NVIDIA and others that already had their sunshine. They've already had tremendous moves. I expect them to take a bit of a breather while the software stocks and the discretionaries, Amazon, Tesla, is driving the market higher, is what we expect in the next few weeks. Finally, I said I'm going to end with Bitcoin. BTCUSD is the 24/7 kind of spot price of Bitcoin. And we can see that it's a classic double top, the bears would call it, at 73 and to 72. Tested it twice, then tested it the second time. Negative divergence, RSI much lower than the previous RSI. This euphoria in the February was when all the ETFs came out, tremendous buying interest from retail and institutional investors into crypto, Bitcoin ETFs. Those that climbed, there was also the anticipation of the halving event that happened in April, keeping the market, and it through April maintained that. But then it was the classic, buy the rumor and sell the news. When the halving happened, we started getting decline in Bitcoin prices. This was looking more like an M-shape kind of a pattern, which bears would call that as a double top. So which means the key level here is the 56K. If that breaks down, that measures towards the 39K. So that's something, of course, to watch. But the way I'm looking at it is, well, we did get a pullback. We went back to the 60, below 60 to the 58. And what caused that? Well, that's where, let's look at this news. There used to be a crypto exchange, Mt. Gox. 10 years ago, 2014, it went bankrupt. There was a hack, and a massive hack where many, many cryptos basically got stolen. So Mt. Gox is finally beginning to pay their creditors, paying about 127,000 creditors, about 140,000 Bitcoins, in returning it back to them. And as they return that back, you would expect these people who had their money stuck for 10 years get those Bitcoins and start selling them is what the market is thinking. So that's where that hit the Bitcoin market drop this week. And also Germany has, as a government, quite a bit, 50,000 or so Bitcoins that it has. It sold about 6,500 Bitcoins last week. So that's the other news that has impacted the Bitcoin market. That said, I'm watching the 56 level very, very strongly. It could perhaps not break. We see this as a bullish reversal. It touched the 200-day moving average towards the 57, 58K, rebounded right back, maintained above 60, and it's holding above 60. So far, it hasn't broken above 60 the rest of the week. This is what happened on Monday when the news hit about Mt. Gox, and it's returning Bitcoins to the creditors, and also German government selling. Since then, it's recovered holding. So if we potentially break back up, the key trend here all the way measures 56 to 73. That's roughly 16 points. Add that to 72. That's roughly 88, 87, 88K. So that's where I potentially feel Bitcoin is headed. So this is more of a bullish flag than really an M-shaped double top. And we need to see, of course. We can never be confident. This looks bullish with the reversal testing the 200 and reversing back strong. Volume has not been as badly as we saw some negative volume here. So this is overall looking reasonably good in terms of more of a consolidation move, and a break higher could easily take it to 87, 88K is what I'm expecting in cryptos. With that, have a great trading week and keep listening into our channel. Thank you so much.